Good morning, everyone. It is 6 a.m., half an hour before the market is about to open on Wednesday, March 20th. Of course, the big thing that is happening today is the Fed rate decision and the press conference that happens afterwards. Because of that, we're not going to expect anything too much different than what we've said yesterday and the day before. And uh, most likely this video will be on the shorter side because there's not that much different and not that much to say other than what we've already said. So let's take a look at the futures. We're really going to expect everything to be relatively flat and stay flat throughout the morning until we get to the actual announcement. So let's go here and take a look at the futures. And yeah, we're very flat. The S&P, not even 10 basis points. The Nasdaq up about 15 basis points, and the Dow down about 15 basis points. We're flat. This is all just a very minor, very random movement over here. So this is agreeing with what we just said. Well, we're probably going to get a very quiet morning with limited range until we get to that FOMC announcement and then the press conference afterwards. That's when we'll start to see more volatility, the potential for directionality, but really at this point in the market and the way that the Fed has been directing expectations, we're probably not going to see a lot of directionality after the Fed announcement or the press conference as well. What is most likely going to happen is we're not going to get the cut. If we go over here and we look at our Fed Watch tool, we'll see that the chances that are priced into the market are only 1% for a cut, 0% for a hike. We're really, the market expectations are at 99% that nothing is going to happen. The Fed, for the last several months, has been trying to rein in market expectations. If you recall, at the end of last year, the market was still pricing in, I guess, 70 or 80, it was like 85%. I wonder how far back this, nope, nope, okay. So in November, December of last year, the chances of a rate cut in March were 80 something, almost 90%. And we were saying how that was really unrealistic. And the Fed started to say out loud, we're going to look at the data, don't expect a cut immediately. We're not expecting to cut immediately. We're going to look at the data. And they kept saying that until finally the market started to listen about February-ish. And we started to get this decreased chances of a rate cut. We really do expect the Fed to continue to say that, especially with the hot inflation print on the CPI and PPI last week. So really, Powell most likely is going to say, we're going to look at the data. We're going to look at the data. The data is going to drive everything. He might also say the data doesn't currently suggest that we should cut soon or that we should cut before X date. If he does that, then what we could see is not in May. May is pretty low chance of a cut, but in June, this has been creeping down. We're at about 64%. We started at about 75%. So we were saying how in June we're still over exuberant. This number should probably be closer to about 20% at this point in time. So if he says anything like that, then we'll start to see this start to move down over, not immediately, not a single day move, but over the course of a few weeks, we should start to see that percentage move down, just like we saw finally, I think it's end of January, beginning of February, we started to see that March number start to creep down. Anything that he says is not going to be too surprising, except for maybe right here, if he starts to give a target, or if he starts to indicate when that rate cut might actually happen. That would be the only new thing. That by itself, on a single day or a 1 week basis, isn't necessarily going to send this market into directionality. We're not going to suddenly go way higher. Well, for sure, if he says that, we're not going to go way higher, but we're not going to go way lower as well. If we look at our indices, our S&P 500 is still in a very nice trend right here. If we pull back, it may cause us to hit that EMA 20 or creep below the EMA 20, just like we saw not in the S&P, but both in the Dow Jones. We see these little dips below the EMA 20, it dips below the EMA 20, and in the QQQ, we see these dips below the EMA 20, below the EMA 20, and they bounce right back. We had one over here as well, and we bounced right back. Here, we're starting to chop sideways. The EMA 8 and EMA 20 are right on top of each other. So now it's normal for it to chop back and forth across both of those lines. So the uptrend is no longer in play in the QQQ. We are now in a sideways trend, and we're not going to get excited if it crosses below the EMA 20. It's a different story if we hit this the MA 50. So what may happen is we could get some directionality that causes us to trade to or slightly below that MA 50 in the QQQ. That's not going to be super directional. That's just very short term, and that MA 50 is likely to hold in the short term. If we keep on testing it, then that's different. We tend not to break immediately. You see, like over here, we cross the MA 50, we bounce, we cross, we bounce, we cross, and that was sort of the real cross downward. This was a very short, relatively short down period. But when we cross the MA 50, we don't tend to just go downwards. There is a recovery, and maybe we poke back above it, and then we go back down. So we're not going to get too excited if we cross below the MA 50, because the market most likely will give us an opportunity for the recovery. And then that's when we might consider flipping our portfolio to the short side. For now, though, we're really expecting sideways movement. There's nothing that the Fed is going to say that is going to be super surprising. They've set themselves up very, very well to say, hey, we're looking at the data. Hey, we're looking at the data. Hey, we're looking at the data. It'd be very unusual for them to suddenly say, we have this target date of cutting right now, when we're saying, before they were saying everything was data driven. Because the question would be, well, why do you have a date now? What in the data showed you that we have a target date now? Because the last data that we got in the PPI CPI suggested they should wait even longer because the inflation popped back up. So there's no good reason, there's no justifiable reason for them to say that, hey, now we have a date. It really have some egg on their face if they started to say that. What they need to do is wait for reports that inflation is coming down. If they said it after a report that came down, then that would make a little bit more sense. After a single report of the inflation coming down, it doesn't make too much sense. After two, still maybe doesn't make too much sense. But if you start getting 3, 4, 5, 6 reports that inflation is coming down, then they could very easily and justifiably say, hey, we have this target date of where we might, or that's target season or few months or quarter where we might start to cut rates. Until we get that data, most likely they're just going to say, we're going to wait for the data. We're waiting to see for the data. So I'm not expecting the markets to get super directional. They almost guaranteed will get volatile during the day. It's at 11 o'clock Pacific time, 11:30, especially Pacific time. That's where we'll really start to see the fluctuation and the volatility in the markets. So how do we know? How do we know if the market is starting to get directional? The way that I'll be doing it is I'll only look at 2 screens, and I'll have the S&P on one and I'll have the VIX on the other. And if we start to move down, what I want to see is a significant movement upwards in volatility, a steep and sharp movement upwards in volatility. If we move down and volatility just kind of moves up, like a normal action, if we follow a linear path in the VIX as the market moves down, I'm not going to get too excited about it. If the market goes down and we suddenly follow a parabolic path, then that's going to be interesting, because then the market makers are fearful. And that could turn into a real movement down below. What we would be looking for is down below this 508.50 level, maybe even this 505 level. That would become significant. And then the opposite is true. If we start to move upwards, then we would be looking for a linear movement. Okay, then we're not going to get too excited. But if we start getting parabolic movement, then we're going to say, hey, people are getting very exuberant. The market makers are getting exuberant. But you know what? We're very, 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 very unlikely to get that. The scenario where we might get that is if there is a surprise rate cut. But again, if they did that, if the Fed did that, then they sort of have egg in their face. They'd be like, well, for the last 4 or 5 months, you've been telling us it's data driven. So where's the data that says it's okay to cut rates right now? So there's probably not going to be surprises. That this today is probably going to be pretty predictable. Now, over the past couple of days, I did say, hey, we don't have a great way of predicting of what they're going to say, the exact language. This market is looking for stimulus. They're looking for any bit of news to start trading and moving in a direction. So if Jerome Powell does not very carefully craft his words, the market could start to interpret something that he says in whatever way they want to interpret it. It could totally not be what Jerome Powell means, but the market could run away with it because we haven't had a lot of stimulus in the market for a few days now. One thing that is going to be interesting to see, though, is the semiconductors, because now it's harder to say that we're going to make new highs. This pullback right here, it went parabolic and it left that at EMA 8 so far that even if we bounce off of this EMA 20, it's going to be pretty difficult for us to match and go above this high right here. Here you can see that we sort of went parabolic, but we're still very close to that EMA 8. Here we went parabolic, but we're still pretty close to that EMA 8. Here we went parabolic. We stayed close to the EMA 8. Here we had a gap up, but we stayed close to the EMA 8. This was the first time we went parabolic, and we have quite a bit of distance between the high right here and the EMA 8. This is also an engulfing candle that's high and its low are above and below the previous candles. And this is a significant range. This is by far the largest candle that we've seen in many months. You don't see anything matching this size since last July, maybe even further. Actually, probably since all of 2023 and 2024. That candle is bigger than that one, bigger than that one, bigger than that one. So that's the largest candle we've seen in a year and 3 months. That's pretty significant. And we have a huge volume spike right here. That is also the largest volume spike we've seen since March of 2022. So this is a very significant and important volume and price day. It's probably going to be very hard to match this. And there's no guarantee, but it's pretty hard. We could call this a capitulation. Normally we'd look for it in the green, to the upside. But in a single day, we made an all-time high, and then we traded way, 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 way down, and we never recovered from it, at least in the past week and a half. So this is significant. It's going to be hard to make a new high, an all-time high. And that could be the beginning of, this could have marked the beginning of a change in trend. We don't have confirmation yet, but if we keep chopping sideways, then we will get that confirmation, or we could continue to move lower. And then the exuberance for technology, exuberance for AI, with exuberance for semiconductors will be temporarily on hold. We need something else to stimulate us and get us beyond that. Maybe it's the NVIDIA conference that's happening right now. Maybe not, but unlikely. After all of this, it's going to be hard for that conference to give us a new wave of exuberance. So what that tells us is that the market is moving into this digestion phase. It's more likely to be sideways than downwards, given the way that all of the indices look. We started to chop sideways. We're going into this consolidation phase. And that's another reason to believe that FOMC today, after the announcement, most likely we're going to chop in a range. It might be a pretty big range, but most likely we're going to chop sideways in that range. After we hit a certain low, it's going to get bid up. And then after we hit a certain high, we're going to get sold back down, most likely. So we're really just going to see, when does appetite come back? When does fragmentation in the sectors end? Because that's when large hedge funds with large pools of money can comfortably start to allocate large blocks of money. When things are constantly rotating, it's very difficult for me to put several million or $100 million to work, because I cannot take a day trade. I cannot take a short-term swing position. I can't take a 2, 3, 4, 5 day, 1 week, 2 week trade on $100 million, on $500 million. It takes time. It take me 2 weeks just to get all my $500 million allocated into a position that I want to take. So we can't take those really short-term trades when we're allocating hundreds of millions of dollars. We have to take at least a 2, 3, 4, 5, 6 month view, if not longer, when we're dealing with that type of money. And in order to put that type of money to work, because it has to be that longer term view, I need to have a clear direction. I need to have clarity on what sectors are going to lead or lag. And we don't have that right now. It keeps jumbling. We had that pattern where we're tech, blue chip, tech, blue chip. Every single week it was flopping back and forth between tech and blue chip since December. So that there's no way a capital manager, a money asset manager, can allocate large pools of money in that type of environment. At best, what's happening is 95% of my capital is sitting there in cash, and I'm playing around with 2, 3, 4, 5% of my capital on day trades, short swing trades, just to say, hey, I'm at least making some return during this period. And this is why you see large hedge fund managers only making 5% or 20% in a year, whereas you see retail traders making 100%, 300% in a year. It's because they don't have the retail trader doesn't have the issue of huge amounts of money to put to work, and they can just get in and out. They're much more nimble than the hedge fund managers. So for now, until we get clarity, until we get defragmentation in the sectors, we're probably not going to get any directionality. We're going to continue to chop sideways. In the past year, right, since October, there was clarity. It was very clear that tech was doing very well, that semiconductors were doing very, very well, AI was doing very well. But what the SMH is telling us is that clarity is starting to go away. And we're probably going to enter this area of chop. So we're not going to get too excited from the FOMC meeting. We're going to associate any move in the S&P 500 with a move in volatility, and that's going to guide us in telling whether or not the move is real. Most likely, none of us, at least in this audience, are going to be day trading the FOMC announcement. So that we could just take a look at this after the market or tomorrow morning. We don't necessarily have to watch it intraday. But if you are day trading it, then this is how you would look at it in order to determine how real or how major a move is and whether or not to get excited about a move. I guess there was a lot more to say, but that should give you a pretty clear picture of not only today, but going forward, we're probably entering a time period of choppiness and moving sideways. So let's go ahead and prepare, even though it's probably going to be a very quiet morning. We'll go ahead and prepare ourselves before the market opens. So I will leave you guys here and I will see you in the aftermarket session.